You're listening to the Businesstalk podcast, a show that brings you conversations with global research scholars and academicians from around the world. I'm Deepak, your host from India. Today we have the pleasure of welcoming Dr. Anup Srivastava as our distinguished guest on the podcast. Professor Srivastava holds the Canada Research Chair in Accounting and Decision Making and Capital Markets at the Haskayne School of Business, University of Calgary. Dr. Anup is one of the world's leading scholars on financial valuation, strategy, governance, and executive compensation issues of modern technology companies. He serves as the editor-in-chief of Contemporary Accounting Research, editor for Accounting Horizons, associate editor for Management Science, and deputy editor-in-chief of Management and Business Review. Before joining Haskell, he taught at the Kellogg School of Management and Tufts School of Business. Among his many honors, Dr. Srivastava was named one of Association to Advance Collegiate School of Business Influential Thought Leaders in 2024 and received the CPA Alberta Distinguished Accomplishment Award in 2025. He also advises the Hiskin Report, serves on the Accounting Standards Board of Canada's Academic Advisory Committee, and mentors entrepreneurs through the Creative Destruction Lab. In today's episode, Dr. Anup Srivastava discusses his research. Do digital technology firms earn excess profits? Alternative perspectives. He examines whether digital technology firms, particularly tech giants, truly earn excess profits and whether such profitability stem from market power of innovation. Now, without keeping you waiting any longer, let us warmly welcome Dr. Anup Srivastava to the conversation. Professor Srivastava, it's a pleasure to have you with us today, and we are truly grateful that you have time taken to be here. Thank you so much.
Deepak, it's great to be here.
Professor, to begin, what motivated you to investigate whether digital technology firms, and especially the big tech giants, actually earn excess profits rather than just high profits?
So, the spark for the question comes from a heated policy debate on this topic. Regulators around the world, the United States, EU, and Australia, have alleged that digital giants are misusing their market power to earn abnormal profits. But there is not much systematic evidence. There's not much systematic evidence on a couple of things. First of all, do they really make tons of profits? Second, how do these profits compare against other sectors? And third, whether these profitability has changed over time or not. And so the important thing here is measurement. Before we dive into solutions on what can be done about this excess profit, first of all, we need to ascertain whether these firms are making excess profits or not. And the problem is that the accounting is flawed. Accounting doesn't work for knowledge technology companies. So, for example, the US GAAP requires firms to expense their most important investments. So, investments made in software, data, customer acquisition, organizational design, they're all expensed as incurred, and therefore profits for growth firms is very low. The second problem is their asset base does not include their real capital, which is their intangible capital. So if we can't measure it, how can we allege that they're making excess profits? So again, the motivation for examining the question was very simple. Before we talk about solutions to the problem, let's define the problem first, and let's first address the measurement. That is, are these firms really making excess profits or not?
Property regulators often allege that digital tech giants misuse market power to earn abnormal profits. How does your research test this claim in a systematic, evidence-based way?
So we have followed a systematic approach. We take a three-step approach. First is let's examine the so-called digital tech firms against other sectors. So we divide all firms into low tech firms, stable tech firms, and even high tech firms. We divide them into digital tech like Microsoft or Apple versus Nvidia versus, let's say, um, a Pfizer, which is a healthcare tech. So again, we are benchmarking digital tech firms against low tech firms and stable tech firms as well as healthcare tech. Second, we examine it over time. So we actually examine it over 40-year period. Uh, and we divide them into decades. So we start from about 1980 and we end in 2020, so 4 decades. So we examine it over time. Third, we use three different measures, and I'm going to talk about those three measures later, but we examine three different measures to look at these profitability. And finally, a very important part of our study is to examine the usual suspects. Usual suspects are companies like Facebook or Google who are alleged to be using their or misusing their market power in order to earn excess profits. So we zoom in on those companies, 5 or 6 companies, and we examine each one of them in details. And finally, we do some market tests as well. That if these firms are actually alleged to be misusing their power, then if a regulator comes after them, that is, regulator tries to reduce their market power, do we see an impact on share prices or not? So we have examined this in a systematic fashion using large databases and using different measures while benchmarking them rather than focusing just on narratives.
Dr. Anup, you go beyond traditional accounting rate of return and use internal rate of return and return on invested capital. Why are these alternative measures crucial for assessing profitability in modern digital tech firms?
So let's start with something that we all know. We all understand return on assets. So return on assets it has two parts. It is return on assets. So there's something in the numerator which is profits, and the denominator we have the asset base. Okay, most of us understand that. The problem is that this doesn't work for knowledge companies. It doesn't work for modern technology companies. This was designed for firms that typically operate with tangible assets, those that use land, building factories to produce physical products such as car and tons of steel. When you're talking about knowledge companies, their biggest investments are in research and development, customer acquisition, or developing soft power, networks, brands, etc. All of these investments are expensed as incurred. So when you invest more on it, your profits go down. So that's a distortion in profits. That's a numerator problem in return on assets. Then none of these assets are recorded in the assets. So you have denominator problem. So when you look at numerator and denominator, profits divided by total assets. Profits is wrong, total assets is wrong. So that's the problem with return on assets as a measure for these companies. So let's look at other measures. Another measure that is proposed in finance is return on invested capital. What it does is it undoes some of the accounting. So intangibles are no longer treated as expenses, they are actually treated as investment. So you correct the profit figure and you correct the asset figure. So asset becomes larger because now you have intangible capital. Profit improves because you have taken care of investments. And so the resulting number is called return on invested capital. Now, even that has problem because it does not strictly match investments to cash flows. Now, you think about any technology companies, they invest with long-term perspective, 5 years, 10 years, 15 years. Look at Amazon. It took 15 years for it to reap the benefits that it invested in 1980s and 1990s, right? So the problem with, so even when you correct for those problems, ROIC does not correct for the problem that there's mismatch between investment and outflow, because both investment numerator and denominator are measured in the same period. IRR is internal rate of return. Those of you who don't know, is a discount rate that equates cash inflows to cash outflows. Simple measure. You invest cash today and there is a cash outflow. What is the discount rate that equates today's investments to outflows? Importantly, this truly measures the economic profitability because it matches cash investments to their cash recoveries. So it takes the whole investment cycle, the whole eco cycle into account, and therefore it leads to better judgment. So just to summarize three measures that we use in our paper: return on assets, which is a traditional accounting measure, flawed because of numerator and denominator problem. ROIC corrects for numerator and denominator problem, but still it is focused on one single period. Internal rate of return takes the whole investment cycle and its outflows into account, and therefore it is a better measure.
Professor, could you explain in simple terms how IRR and ROIC differ from ARR and why ARR alone might be misleading when we look at firms rich in intangible like software and data?
So, simply speaking, as I say in one of my Harvard Business Review articles, the more an intangible intensive firm invests in its future, the bigger are the losses it reports. So, it is investing in building its future, the higher are its losses. It should be the opposite. If a firm is creating value, the profit should be higher, its profitability should be higher. That's the problem with return on assets. Here we have problem with numerator. Profits are calculated after deducting the most important investments. So think about it. When you invest in factories and buildings, you capitalize those investments. You think of them as creating capital base. They're not deducted in calculation of profits. But when a knowledge intensive firms invest in R&D or trying to attract customers or create a network or try to create a brand, those investments are immediately deducted. So the profit is wrong. And the asset base is wrong because the most important assets never find their way into the balance sheet. So that's the problem with return on assets. ROIC, as I mentioned, corrects for at least correct for some problems, but it still does not capture the whole cycle of investment and payoff. IRR is like a movie. You're actually tracking, it's like you're tracking the whole story. You're looking at cash investments today and cash outflows tomorrow and trying to see, yes, there are some problems with IRR as well because it takes the whole cycle into account. So the firms that do not survive over a long period of time, they're not in our sample. But the firms that survive, we are able to accurately measure what was the return on each investment, which is based on cash inflows and cash outflows. So again, to summarize, yes, ROA has problem. Please never ever use return on assets to judge the profitability of a knowledge intensive company. Return on invested capital corrects for at least some problem, but it still suffers from a fundamental problem. It is a one period measure, one period profitability, one period investment. IRR is the only one that takes the whole cycle into account and it treats the company as multiple projects going. Company invests today, reaps the benefit tomorrow. Another project started, reaps the benefit tomorrow. So the whole cycle is taken into account. So it's a truer measure of economic profitability.
Professor, your study finds that inferences based on IRRs differ from those based on ARRs and ROICs. What are some of the most striking differences in the story these metrics tell about digital tech profitability?
So the whole allegation is that these digital tech giants are making abnormal profits, right? That's the start of the story. That's the basis of all the allegation. When you look at return on assets, that's a traditional measure. Surprisingly, you find that digital tech is not a good performer at all. Surprisingly, the best performing sector is a low tech sector. That's not what we thought. I mean, nobody's alleging today that low tech firms are exploiting their monopoly position to make profits. So, when we use traditional measures like return on assets, we find that the best performing sector across decades is low tech. Okay. ROIC tells a slightly different story, but we'll come back to it. When you look at IRRs, it tells you a totally different story. In fact, I will use Amazon as a classic example. Amazon, based on traditional measures, in the first decade, reported consistently reported losses. So you look at accounting measures and you'll say it's a badly performing company, which is going to fail any moment, right? And there's no evidence that it is exploiting its extraordinary market power to indulge in anti-competitive practices. When you look at IRR, you get a totally different story. Negative numbers flip to positive. When you look at IRRs, you're talking about 40% plus returns for companies like Facebook, Amazon, Microsoft, Apple, which is what is reflected in their market prices. So when you look at internal rate of return, that's our preferred measure, suddenly you find that the best performing sector is digital tech. When you look at traditional measures like accounting return, that's ROA, you find that old tech, the so-called low tech firms are the best performing sector. So if you believe in markets, if you believe in the fact that some of these digital tech giants or digital tech sector has performed extraordinarily well, it is better reflected in IRR than in return on assets. So to summarize, if you just focused on accounting measures, you will say none of these companies are making money. At least they're not making lots of money. When you look at IRR, then suddenly the story flips. And then you find that these companies are making 40%, 50%, 60% IRRs. And that is actually consistent with their true uh, returns as well.
Professor, the paper concludes that the digital tech sector is now the best performing sector and that the gap between its profitability and the cost of capital has widened over time. What does this widening gap practically mean for investors, policymakers, and competitors?
So let's first understand why even measure this gap. So any economic student, undergrad student understands that if you earn a lot of profits more than the cost of capital, then it is treated as supernormal profits or excessive profits. And then comes the question whether it comes from genuine innovation or it comes from exploitation of market power, right? So that's the starting point. So we're looking at gap between performance and cost of capital. Excuse me. Now look at 21st century. 21st century, at least in US, is characterized by very low interest rates. So very low cost of capital, right? Literally in single digits. And then you look at IRRs. You're talking about 30, 40, 50%. So you subtract this single digits from 30, 40 odd percent, 50%, 60%, and you see large gap, and which is consistent with the idea that firms are making excessive profits or supernormal profits. Okay. So that's the first piece of evidence that was systematically missing from prior literature. So we document that yes, these firms are making a lot of profits, much higher than their cost of capital. And surprisingly, since we also do time series, this gap is diverging. That is, the supernormal profits, the gap between supernormal profits and cost of capital is widening dramatically. Now, what does it mean for, I think you asked investors, policymakers, and competitors. So first, let's start with investors. It sort of justifies the high valuation that investors have put on these companies. These companies have become trillion-dollar companies, 2 trillion, 3 trillion, 4 trillion. We're talking about even $5 trillion. Just to put in perspective, $5 trillion is more than India's GDP. So we're talking about large valuation, which is consistent. So this supernormal profits is consistent with what investors have placed their emphasis on, which is, are these firms making the right kind of investments, and whether these investments are paying off or not in long term, right? So that's for investors, and which also means that please disregard accounting numbers and focus on true profitability. If you just focus on return on assets, then you might be totally misled. Okay, so there are alternative ways. I have several papers on this idea, not just this paper, but several papers, other papers, where we show that if you use modified numbers, then it is more consistent. It helps you make more money if you use those numbers and invest it in stock markets. Policymakers, the implication is not clear. Remember, the whole motivation of the study is these companies are making supernormal profits, and it is possible that they are actually misusing their market power, abusing their market power in order to make this kind of money. But it is also possible that they have genuinely innovated and have earned the ability to earn so-called rents, economic rents, right? So for policymakers, this could be the starting point. I think we have offered a concrete evidence that these firms are making supernormal profits, which at least didn't exist. Now it's for policymakers to figure out whether this is because of genuine innovation or is it because of misuse of market power. For competitors, the our study is not very clear. Okay, and I can talk about a few tests, but interestingly, if you think that normally if there's a dominant player and they are misusing their power, then if you try to squeeze them, the other competitors should benefit, right? Surprisingly, when you squeeze, let's say, Microsoft or Apple, then the competitors actually are worse off. So it's likely that these companies are not just they're not. It's this is consistent with the story that they're not misusing their market power. On the contrary, they're creating an ecosystem which, when these companies benefit, the other players in the industry benefit as well. Okay. Again, this is not black and white, but at least we do not find the evidence to show that these companies are misusing their power in order to exploit customers or in order to exploit the competitors. So, in summary, I think we have provided, as I said, the starting point was measurement. If you cannot measure it, you cannot manage it, right? It's an old saying. So, first, you need evidence, and we provide a systematic evidence that these companies are making lots of money. For investors, it justifies their valuation, but it also tells investors, please disregard accounting numbers, focus on the true economic performance. For policymakers, figure out whether this abnormal profits is because of genuine innovation or because of misuse of market power. For competitors, the strategy is not clear. I believe, at least our paper suggests, that competitors are also benefiting because the whole sector, the whole industry is benefiting from these tech giants.
Professor, you adjust ROIC for capitalized intangibles when computing profits and invested capital. How much does bringing intangibles onto the balance sheet change our view of whether digital tech firms are over earning?
So I think this is a very important point in the paper. People normally think that if you adjust for intangibles, then your problem is solved. Return on invested capital, you have adjusted the profits because you have adjusted for capitalization. You have brought some of the intangibles into the balance sheet. So asset base is collected, profits is corrected, asset base is corrected. So ROIC should now start reflecting economic profits. The problem is that actually twofold. Problems are twofold. First of all, ROIC is a single period snapshot, profits over assets. So it does not match investments to the outcomes. The second problem is ROIC. It still is based on tons of accounting assumption. There's depreciation assumption. There are other assumptions that go into it. Here is the most counterintuitive thing. You think that by adjusting for intangibles, suddenly the profitability should appear better because now we are adjusted for intangibles. Surprisingly, find that ROIC for these companies is even lower than return on assets. So you adjusted for intangibles, your profits has gone up. How come their profitability appears lower? And the reason is that we are not only adjusting numerator, we are also adjusting the denominator. So there's a percentage change in profits, calculated profits, but there's also a percentage change in the denominator. The asset base has also increased. So numerator increases by a certain percentage, but denominator increases by a bigger percentage. So ROIC actually goes down. So surprisingly for these digital giants, you'll find that ROIC, return on invested capital, is lower than their accounting rate of return. That's ROA. So going back to your original question, does capitalization of intangibles in ROIC changes the picture? Starting point being accounting numbers? No, it does not. You still you get a picture that's worse off than return on assets. Again, maybe I'm overselling internal rate of return too much, but IRR provides a truer picture of economic profits of the company.
Professor, a key takeaway is that the study is unable to cleanly separate the role of market power from the role of innovation in driving high use internal rate of return. How should regulators and public interpret this ambiguity when debating antitrust action against big tech?
It's an excellent question, and the answer is not clear. Um, think about Amazon. Amazon has been one of the biggest innovators in last 30 years, right? There's no doubt about it. In fact, I think Amazon today is the best supply chain management company in the world. Okay, think about yourself. When you order something, it gets delivered within a day, and it's not just because of their whole supply chain, but they're also using predictive demand. They can predict your demand, and they have structured the supply chain in such a way that it comes to you within a day. Okay, so there's a lot of innovation, but Amazon has also killed the competition. Amazon is 10,000 pound gorilla in the market. As a seller, you have no other option other than to deal with Amazon and to deal with Amazon's policy, right? Amazon offers its own products, uh, its own branded products, which are competing against the third party products being sold on Amazon's platform. Now, how can you compete with Amazon's own product? Because Amazon has real time information about the market, what is selling, what is not selling, what is the best price, so on and so forth. So, how do you distinguish whether Amazon is Amazon today? Is it because of its genuine innovation, or is it because it exploits its market power? So, this is the important question which we try to examine, and we find evidence consistent with both. We find that these firms, so we use something called as economic values of patents. We look at some citations into account. We look at some value that their innovation is creating, scientific value, etc. Of course, these firms are by far the biggest innovators in the world. That's one angle. But on the other hand, we find evidence consistent with the fact that they could be exploiting their market power. So, if you were to ask me this question, is there high profitability because of genuine innovation, or is it because they are exploiting their market position? We are not able to cleanly answer that question.
Professor, if you were advising regulators, what kind of additional data or analysis would be needed to more clearly distinguish between profits driven by genuine innovation versus those driven by anti-competitive behavior in digital markets?
Great question, $1 trillion question. This is the biggest question in front of regulators today. How do we control these tech giants? Uh, I will take a step back and I say that, look, as a researcher, we are looking at company as a whole. Now, Amazon is not Amazon. Yes, Amazon, we are looking at company as a whole, but it is made up of multiple companies. It's made up of multiple projects. So we do not have data on exactly which part of the company is paying off what and what was the initial that went into it, which investments failed, which investments succeeded, which ones paid off. Regulators can ask companies for those data. So you need granular project level data, you need investment data, you need pricing data, you need uh, uh, success rates, you need failure rates, and then regulators can figure out whether the initial investment created supernormal profits or it was a failure or somewhere in between. So to summarize this point, instead of company as a whole, you look at project by project, investment by investment data, which regulators can ask for. The second point is to look into actual operational decisions, which is, are there some exclusion restrictions? For example, do they exclude uh, their their competitors from joining? Are they going out and acquiring some of their potential competitors? We all know of Facebook going on and acquiring Instagram and and WhatsApp, which was to eliminate competition. So regulators are in best position to actually examine these questions. And then finally, we have to figure out from customers' perspective and suppliers' perspective how much they are locked into these networks. Uh, are there switching costs? Can they actually do they have any alternate avenues available? What are the restrictions to portability? Uh, what can you port your data? Can you port your marketing channel to something else? So we have provided preliminary evidence, but it's it's regulators who can ask for granular project by project data, and they can examine some of the operational decisions taken by firms to come out with a more accurate assessment on whether firms are using genuine innovation or abusing their market power to make these supernormal profits.
Professor Anup, I would like to conclude this episode with one last question. Looking ahead, how do you expect digital tech profitability to evolve, and what implications do your findings have for traditional valuation models, corporate strategy, and executive compensation in technology companies?
So let's talk about valuation, strategy, and executive compensation first, and then we'll talk about future. First of all, valuation, we all know this, but I'm going to repeat that you cannot use the traditional measures to be inputs in your valuation model. So, if you're using price to earnings ratio or market to book ratio, both earnings, that's profits per share, earnings per share is wrong. If you're using market to book ratio, book value is wrong because asset base is wrong, right? Just to give you an idea, Apple's market cap is 50 times its book value. 50 times. So I'm not talking about 50% difference. I'm talking about 50 times 100, 50, whatever it is, 5,000% different. So you cannot use accounting numbers. You need to deep dive, you need to understand strategy, you need to look at value creating investments and look at long term uh, payoffs to accurately assess valuation. As far as strategy is concerned, I think gone are the days where we could assess strategy based on short term payoffs. Okay, these firms are making big bets. We all know Google investing in Waymo. Say, what is search engine? What has that got to do with a car company? But they're making long-term bets, and their strategy is based on risk and return assessment. They're investing in real options, and the real options means that make small stage investments. And if that project succeeds, invest more. If that fails, pull back, like Apple pulled back from a car project. So strategy is about making staged investments and try to develop options. If the technology succeeds, if the market succeeds, if the production technology succeeds, then you go for it. If not, then pull back. That's as far as strategy is concerned. Gone are the days where you invest in blast furnace and steel and then say, I'm going to produce so much tons and this is the profitability I'm going to earn. Those deterministic days are gone. Your accounting rate of returns, those assessments are wrong. Okay. Let's talk about executive compensation. Executive compensation based on accounting's profits is not only wrong, it is detrimental to the interests of the company. So let's take a simple example. You incentivize a manager based on profits. What is manager's first strategy? They'll say, let's cut R&D. Let's cut back on brand building because doing so is going to improve my current profits, right? Cut back on R&D, cut back on brand building. That's the biggest investment that these companies have to make. So if your executive compensation is linked to accounting numbers, it's counterproductive. It's actually acting opposite to what creates value for the shareholders. So both for valuation, not both, for valuation strategy and executive compensation, you need to look deeper into numbers. You need to create alternate ways of looking things, and then create metrics that are really creating long-term value for the company rather than just this single shot deterministic way of looking at things. Finally, what does it look ahead? What does future hold for big tech? Big tech has been, at least for last 20 odd years, they have been the dominant phenomenon. Um, Between them, they have about, I think they're valued about $15 trillion. Um, just five or six companies. Um, they have become big, they have been successful. Surprisingly, the biggest shock for them, before AI, I would have said that these long term projects are paying off, their investments simply because of their massive flywheel that they have. They will continue to perform very well and they will continue to beat the competition, so on and so forth. AI is a big disruptive force that perhaps you know better than I do. And in the AI age, whether these big tech will be able to reconfigure themselves as AI players, it's not clear. It's the innovator's dilemma. Do we kill our business model in order to recreate something, or do we continue to focus on our existing business and on profits? So that is unclear, and that story is yet to be written.
Thank you, Professor Anup Srivastava, for sharing your insightful perspectives on digital technology firms, profitability, and market power today. Your work offers a nuanced lens for understanding how innovation and economics intersect in the modern tech industry, and it has given us a great deal to reflect on. We appreciate your time and thoughtful discussion today. Thank you once again.
Thank you, Deepak. It was great to be with you today.